CFD trading has become incredibly popular over the last few years, and with the rise of online trading platforms, it's now easier than it ever has been to trade CFDs. And there are thousands of people online who claim to make a living trading CFDs, and many of whom will charge thousands of pounds for online courses claiming to teach how to trade. So, is CFD trading a reliable way to build wealth over the long term? Or is it actually just glorified gambling? This video will explain exactly what CFD trading is and how it works. And we'll discuss how viable a strategy it is for making money over the long term. Hi everyone, welcome back to the channel. My name's George and I'm a finance professional working in the UK. And over the years, I've tried many different investment strategies, from passive investing to picking individual stocks to CFD trading. But today we'll talk specifically about CFD trading. And in order to determine whether it's a sensible strategy for building wealth over the long term, we first need to take a step back and understand what CFD trading actually is and how it works in practice. So, a CFD, or contract for difference, is a financial derivative product which allows traders to speculate on the price movements of various different assets, such as stocks, commodities, or things like currency pairs, without having to actually own the asset itself. And when you buy a CFD, you're essentially entering into a contract with a broker to exchange the difference in the asset's price from the time you open the trade to the time you close it. And you can be on either side of this contract, as in, if you think the asset's price will go up, you can buy CFDs or go long, and if you think the asset's price will come down, you can sell CFDs or go short. So, for example, say that the price of oil is £100 a barrel, and you think that the price of oil is going to go up. So you go to a broker and buy a CFD and go long. Now, let's say that you're right, and the price of oil has gone up from £100 a barrel to £110 a barrel, and you decide to cash in and close the position, in which case the broker will then send you the difference in price, which in this case is £10. And of course, this would have worked the other way if the price of oil had gone down. So let's say the price dropped from 100 down to 95. Then you'd have to send the broker the difference, which would be £5. Okay, so that's the basic premise of CFDs. But what really makes them special is their ability to incorporate two related concepts. That's margin and leverage. So at the point at which you go long or short on a CFD, you're not actually buying or selling anything. Essentially, you're just entering an agreement with a broker to exchange the difference in price between the point at which you open the contract to the point at which you choose to close the contract. And it's not until the point where you close the contract that any money actually changes hands. But because there's a chance that you'll lose money, as in if the price of the asset moves in the wrong direction, you'll then owe the broker the difference in price. The broker requires you to place a deposit with them to guarantee that you'll be able to make this payment if you need to. And this deposit that you have to pay is usually called the margin, and it's usually a percentage of the overall position that you control. So to go back to our oil example, if it currently costs £100 a barrel and you think the price will go up, so you want to go long on a CFD, the broker will then say to you, okay, oil CFDs come at a 5% margin. So to control a position of 1 barrel of oil, that is a position of £100, you'll have to pay a £5 deposit or a £5 margin. So this situation creates something really interesting. The CFD has allowed us to be exposed to a trade worth £100, but we've only had to deposit £5. Essentially, we're controlling a position which is 20 times larger than the money we've actually put down. And this is exactly what leverage is. Think how a lever allows a small force to move a really heavy object. A small deposit allows you to control a much bigger position. So what CFDs allow us to do is really scale up our position. Let's say you're really confident that the price of oil will go up, and you want to stake, say, £500 on this. Now, because each barrel of oil only requires a £5 deposit because it trades at a 5% margin, with a deposit of £500, we can then control a position of 100 barrels of oil, which is collectively worth £10,000. Now, if we go ahead and do this, we're essentially exposed to the price changes in 100 barrels of oil without actually having to own anything. All we've done is sign a contract. Okay, let's say that we're right and the price of oil goes up to £110 a barrel. Okay, excellent. Let's close the trade for a profit of £10 per barrel or £10 per CFD. As our position was 100 barrels of oil, our total profit was £10 per barrel times 100, which is £1,000 profit, which is great when you consider the initial investment was only £500. Now, this is obviously a very ideal scenario and shows just how good the upsides of CFD trading can be. But now let's think about what would happen if we were wrong and the price went down. So let's say that instead the price of oil dropped from £100 a barrel down to just 95, so only a small drop. Now this would mean that we were £5 down on each barrel, so we were down £500 in total, which was the value of our initial investment. So at this point, if we were to close the trade, we'd be completely wiped out and lose 100% of our investment. But let's say that we held on and kept the trade open, but the price of oil kept dropping. We'd then be in a position where we were down more than our initial investment. So hopefully that makes clear why CFD trading is often seen as a very high risk trading strategy, as the upsides can be brilliant, but the downsides can be absolutely horrific, as you've got the potential to lose way more than you initially invested, even if the prices move just slightly against you. So you might be thinking, okay, I understand that it's high risk, and if a trade goes bad, it can be really bad. But surely if I spend enough time analysing the markets and making good predictions, I'll be able to consistently make money, as over the long term, the good trades will outweigh the bad trades. Well, this is a fair point, but we'll now discuss why it can be really, really difficult to consistently make money trading CFDs. So in order to make money, CFD traders will try to take advantage in the price volatility of assets over a short time frame. And because trades happen over such a small period of time, this can be weeks, days, or sometimes even just a few hours, the change in the asset's price will have basically nothing to do with changes in its intrinsic value, as this changes gradually over a long period of time, and instead is based on simply the activity of buyers and sellers within the market, sometimes known as market noise. And what CFD traders will try and do is make money by exploiting these short-term fluctuations by hopefully going long before the price jumps up or going short before the price falls down. And they'll try and predict this by performing an analysis of the market. And this analysis can take a number of different forms. Probably the most well-known form is known as technical analysis, and this is where traders analyse the previous movements in the asset's price in order to predict what might happen next. And this is what you often see traders doing when they're staring at candlestick charts on their 12-screen display. And another form of analysis is known as sentiment analysis. This is where traders will try and gauge the psychology of a market, as in how investors are feeling about an asset at a particular point in time. If we think back to January 2021, when the price of GameStop went absolutely mad, driven by essentially a social media frenzy, and traders tried to take advantage of this by going long on the stock to ride the wave, or by going short to take advantage of the inevitable crash when the bubble burst. And another, much more advanced type of analysis is known as quantitative or algorithmic trading, which is where traders will use algorithms and mathematical models to try and spot trading opportunities. And this can be a really, really effective trading strategy. Some people have made literally billions of pounds using this method. However, it's way beyond the reach of 99% of individual traders, and can only really be accessed by institutional traders like banks or hedge funds due to the deep expertise required and the massive costs associated with using these methods. But you might still be thinking, right, that doesn't actually sound that hard. Maybe algorithmic trading is a bit beyond my reach, but surely I'll be able to learn some technical analysis techniques and I'll be able to gauge market sentiment by scouring the news and social media. Well, yes, you might be able to, and people do make a living doing these types of things. But before you sign up to a £5,000 day trading course, there's one key piece of information that you really need to know. Now, this isn't true for all types of trading, and it's certainly not true for long-term investing. But when it comes to short-term CFD trading, traders are essentially competing with one another within a zero-sum game. Think about a poker game. The only way to win money is to win it off other people. If you win £100 in a poker game, it means that other people have collectively lost the £100. So no new value has been created, it's simply changed hands. And this is essentially what's happening within short-term CFD markets. Just think about this. Over the course of a day, the intrinsic value of an asset will basically not have changed. However, some CFD traders may have made millions of pounds betting on the price fluctuations of that asset within the day. And this value won't have come out of thin air. It'll have come from the losing traders. So if you trade CFDs of an asset, you're essentially competing with all the other CFD traders of the same asset. And these are the traders could be experienced professionals who spend 60 hours a week concentrating on one asset in particular. Or they could be institutional traders like hedge funds who invest millions of pounds in state-of-the-art algorithmic trading techniques. Personally, I like to think of trading as trying to play poker against professionals. Yes, you might get lucky on a few good hands, but if the average poker player was to enter the World Series, they'd likely get annihilated by the professional competition and leave with their tail between their legs. And it's often a similar story with novice CFD traders. Many will get wildly outcompeted by the professionals and lose a hell of a lot of money. And it's no surprise that 80% of retail CFD traders will lose money. So what does all this mean? Well, for me, it means that I should definitely steer clear of CFD trading, as I know there's no way that I'll be able to dedicate enough time and energy into learning how to trade in order to compete with the professionals. So the chance of me consistently making money is very slim. Yes, I might get lucky on a few trades, but the law of averages says that it's very, very unlikely that this will continue into the long term. And I suppose my overall message, if you're thinking about trading CFDs, is please be really, really careful and make sure you understand the risks first. But even if you spend months learning the ropes, it's entirely possible that you'll still be outcompeted by the hedge funds that use algorithmic trading techniques that you're just never going to be able to access. And it's definitely not a surefire way to get rich in the short term, nor is it a sensible strategy for building wealth over the long term. And unfortunately, the reality of the world is there are no genuine get-rich-quick schemes. But if you are interested in learning how to build wealth over the long term, then there's no better way than learning about how to invest in the stock market over the long run. And if this is something that you're interested in, you might find value in some of my other videos on this channel, as we've got many more videos on the topics of personal finance and investing, and many more in the works to come. And if you've got any questions for me, or you want to share some experiences of CFD trading, then please leave me a comment below, and consider subscribing if you've enjoyed this video. Thanks for watching.